So now, children, we have completed admission of a partner. Now we are moving to retirement of a partner. So in this chapter, retirement, the meaning of retirement is partner leaves the firm, he exit from the firm, he go away from the firm. There are various reasons the partner may go out of the firm. There are several reasons. So either by according to the agreement after expiry of time, or maybe as per his own will. So whatever may be the reason, the partner leave the firm. So when the partner is retired, an amount is payable to the retiring partner by the firm. So we need to calculate the amount payable to the retiring partners. So there are other valuations also, other treatments are also there. When the partner goes out of the fund, there are many things are affected. Like when a partner comes in admission, there are many things, many changes takes place. So here also, so when the new partner goes out of the firm, when a partner retires, so we have to find out the new profit sharing ratio and gaining ratio also. In admission, we calculated sacrificing ratio. Now in a retirement, we need to find gaining ratio. After that, treatment of goodwill, same as other things, are almost similar in admission, similar to admission. Revaluation of assets and liabilities. So in this retirement also, we have to revalue the assets and the liabilities. So to deal with the accumulated profit or loss and general reserve, that is to be distributed among the old partners. So before a partner retire, the old profit, accumulated profit or reserve should be distributed among the old partner. The treatment is same like as we have done in the admission of a partner. So sometime when the partner go out, he may take the assets, he may take away the assets, or he may take the burden of liabilities. So we have to pay to the, after that we have to, after the adjustment, we have to pay to the retiring partners. So in this chapter, we have to calculate the gaining ratio, because when a partner retires from the firm, so his share of profit goes to the remaining partner, continuing partner. When a partner retires, when a partner goes out of the firm, his share of profit goes to the continuing partner, the remaining partner. So the remaining partner will get more profit than before after the retirement of the partner, because when there is a profit, three has to, ABCR partner, three has to divide the profit. Now one has gone out, the profit has to be divided among two only. That means they will get more profit, more share of profit than before. This is because of the gaining, because the continuing partner will get the share of the outgoing partner, retiring partner. So that's why the continuing partner will get more share. So that's why there is a gaining ratio here in the retirement. So here the new ratio is more than the old ratio. So the gaining ratio is calculated by new ratio minus old ratio is the gaining ratio. Whereas in the admission of a partner, we calculated sacrificing ratio. In admission, sacrificing ratio we calculated, which was calculated by old ratio minus new ratio, sacrificing ratio. But here now in retirement, we are going to calculate the gaining ratio, that is new ratio minus old ratio is the gaining ratio. So this is about the gaining ratio. Treatment of goodwill here. So treatment of goodwill is the new partners, the continuing Continuing partners capital account debited to outgoing partners is the treatment of goodwill here. So when the uh, retires, when a partner retires, the valuation of goodwill, the calculation of goodwill will be here. The continuing partners capital account debited to retiring partners capital account. So in case of the fixed capital method, continuing partners current account should be debited and retiring partners current account should be credited. But here when capitals are fluctuating, so continuing partners capital account should be debited in the gaining ratio to outgoing partners, to retiring partners. So this is the treatment for journal entry for the goodwill. So journal entry is continuing partners capital account debited to retiring partners capital account credited. So this is the journal entry for the goodwill, treatment of goodwill. This much only. If there is any old goodwill in the asset side of the balance sheet, old existing goodwill, that is to be written off. To write off the old goodwill, all partners capital account debited to goodwill account. To write off the old goodwill, all partners capital account debited to goodwill account. All partners capital account should be debited in the old ratio. All partners capital account debited to goodwill account. So in this way, this is the goodwill treatment of goodwill. So after that, so revaluation of assets and liabilities as usual, as you have done revaluation of assets and liabilities. Revaluation means re-examination, revaluing the value of assets and liabilities. So you have to compare the value of asset and liabilities given in the old balance sheet and the value of market value of the assets and liabilities. If the asset increases or liability decreases, that is to be credited to the revaluation account. Credit side of revaluation account, asset increase, liability decrease, and debit side of revaluation, asset decrease and liability increase. So the profit on revaluation is to be distributed among all the old partners in the old ratio, as you have done in the admission. Same revaluation account is same here. Revaluation account is same as admission of a partner. So after that, preparation of partners capital account. So partners capital account here, the partners capital account, the preparation is almost similar, but only for one partner, retiring partner, his amount is payable. The amount the retiring partners may sometime leave his amount, whatever he has to get from the farm, he may leave that amount in the farm in the form of loan, or the farm may pay to the retiring partner. So when the farm pays to the retiring partners, to bank account, in the debit side to bank account, amount payable to the retiring partners will be paid fully. Whatever is the credit side, whatever is the credit side in the partners capital account, that much is paid to partners capital to bank account, and the other two continuing partner will be to balance sheet. And the remaining partners, only A and B capital will be shown in the liability side of new balance sheet, and the amount paid is deducted from the cash in the balance sheet, the asset side, from the cash, the amount paid. Otherwise, if it is not paid, if the retiring partner has left the amount in the form of loan, so his loan amount will be shown separately in the liability side in the new balance sheet. The amount payable to the retiring partner is shown separately in the new balance sheet in the liability side. So I'll show you one simple question. So this is the retirement portion. So now I will show you a simple basic sum on this. topic. Now we are going to solve this accounting treatment of goodwill. So question number 14. R and S are partners in the ratio 5:3:2 ratio. S retired from the firm. Goodwill is valued at 42,000 past journal entries. So this is the question. Now in this question, S is retiring and R and T is continuing. So the entry will be here. Continuing partners capital account debited to outgoing retiring partners capital account. So continuing partner is R capital account is debited. R capital account is debited. T capital account is also debited. To S capital account. So S share of goodwill is, total value of goodwill is 42,000. So 42,000, S share is 3/10. So that means 3/10. So total, so S share of goodwill is 12,600. S that is credited, 12,600 is credited. And R and S is debited by the gaining ratio, that is 5:2, 5/7, 2/7. So that means here S share, if you see here, S share of goodwill, S share of goodwill is equal to, total value of goodwill is 42,000 into S share is 3/10, so is equal to 12,600. 12,600 is the S share of goodwill. Now this S share of goodwill is to be debited to R and T in the ratio 5:2. So that means R will be here 12,600 into 5/7 and T will be here 12,600 into 2/7. So R will be 9,000 and S will be 3,600. So R capital account to be debited by 9,000 and T capital to be debited by 3,600. So in this way, the continuing partners capital account debited, R capital account debited, T capital account debited, to retiring partner, that is S capital account credited 12,600. His share of goodwill is credited. S share of goodwill is, total value of goodwill is 42,000. In his share is 3/10, that is 12,600. So S capital account is credited by 12,600 and R capital account debited to R capital account debited and T capital account debited in the gaining ratio. R capital account debited 9,000 and T capital account debited 3,600. So this is the treatment of goodwill. So this is a journal entry. So the narration will be here. As retiring partner share of goodwill, adjusted, debited to retiring partner share of goodwill, here, retiring partner, narration will be here, retiring partner share of goodwill debited to continuing partner, to R and T in the gain ratio, that is 5:2. So this is the narration for the goodwill, is journal entry. So hope you have understood. So all questions are like this only. All the entries are like this. Continuing, the main entry is continuing partners capital account debited to retiring partners. capital account.